In this week's video, we'll review the latest charts to help us answer the question, is the bull market poised to push higher? We'll be moving very quickly this week, so feel free to use the pause button on your video player. Study number 1. The percentage of NASDAQ stocks greater than their 150-day simple moving average hit a new high for the rally on Thursday, February 4th. After a major sell-off, that level has only been reached on 2 previous occasions, June 18, 2003 and September 6, 2009. How do the next 4 years look in the stock market following the 2 previous signals? Keeping in mind our signal dates are similar to February 4th, 2021. In both cases, the longer-term and already established bullish trend remained intact, and there was a lot of volatility between point A and point B, spanning 4 years. Having said that, the gains were very, very attractive. 58.84% is the additional gain walking forward from this point in 2003. The additional gain from 2009 here, 51.58%. And that's spanning exactly 4 years. These charts tie in nicely with the topics we've been covering in recent weeks and months. History tells us that it could be more volatile going forward. History also tells us that the path going forward in the short run could be highly variable, including having gains take place from where we are today and having the consolidation take place from higher levels. So back to our signal hot off the presses on February 4th. The longer-term path, very favorable in both cases. The shorter-term path, a little bit different and more uncertain. In the first case, after a drawdown here, good things happened for a long period of time because this is several months in here. And then consolidation occurred from higher levels relative to where we would be today, hypothetically. Second case, quite a bit different. For the most part, the market did not make much progress looking out several months and was highly volatile. So buying here at this point and holding from here really didn't buy you much. That's quite a bit different from this scenario, where any buys in this area here remained profitable during this consolidation phase. Studying history and performing these studies helps us with contingency planning, and that in turn helps us keep an open mind about a wide range of outcomes on all time frames. And realistically, when we talk about trading the chart in front of you, we're really talking about trading the charts in front of you. Numerous charts on multiple time frames. They say the best race car drivers look a little bit further down the road than the average race car driver. This may be the chart in front of us. Think of this as the daily chart. The weekly chart gives us a little bit longer term view. Same with the monthly charts, quarterly charts, and annual charts. If I have some idea of what the road ahead might look like, I might change my approach to this corner, knowing that a straightaway is coming on the other side. Remember, the best race car drivers look further down the road. Thus, when we trade the chart in front of us, let's say the S&P 500, and we understand multiple scenarios, it can significantly increase the probability that we navigate between this point A and this point B several years down the road. And these concepts are not particularly new. We've been talking about the Nordique phase for some time. This slide was from the December 4th video. And remember, the Nordique's logo told us gains from this point of the bull market could be given back before the market starts to rise again. What we don't know is where that give back starts and how far it drops. So it's possible that we have gains for several months and the give back never comes back to present day levels. And that's basically this scenario here. This scenario here is more like the traditional Nordique logo. Moving on to study number 2. Like the first indicator, this indicator tracks breadth on the NASDAQ Composite Index. I have data going back all the way to 1998. We're looking at all of the data. Very, very rare to see the NASDAQ Summation Index up in this level here. It's only happened one previous time, June 12th, 2003. We hit that level recently, January 22nd, 2021. June 12th, 2003 is very, very close to the first signal we covered, which was June 18th, 2003. Thus, we already know really what happened walking forward from mid-June of 2003. We already covered that. Really, really good things happened. The drawdown was relatively minimal, and the consolidation or give back occurred from much higher levels, aligning with this scenario. Let's move to study number 3. CCM market model uses a weight of the evidence approach. First two studies looked at data from the NASDAQ. Now we're looking at data tied to the NYSE Composite Index. NYSE stocks greater than their 150-day simple moving average. We've covered this recently, but it's noteworthy. We hit a new high for the rally on January 20th, which means this indicator is even more extended than the last time we looked at it. Only 2 previous times after a major low have we moved back to this level here. After the low in 2009, hit the blue line here, and after the major low in the S&P 500 that occurred in October of 2002. How did the stock market perform in the 2 historical cases? Once again, we'll walk forward 4 years in the S&P 500 to see what we can learn about probabilities walking forward from January 20th, 2021. Similar time periods, similar signal dates, and similar outcomes. Very, very good things happened over the next 4 years. 56% was the additional gain in the first case. The additional gain in the second case, 72.16%. And since the S&P 500 closed at 3851 on January 20th, not much higher on February 4th, 3871, that's 20 points. This is all still relevant to early February 2021. This signal that just occurred on January 20th helps us keep an open mind about a wide range of outcomes on all time frames, including seeing the market rise before it consolidates, seeing the market rise for several months. This is a big gain in here before the give back, and the give back never comes back to the date of the signal. From the date of the signal, good things happened, and the inevitable consolidation led to limited drawdowns from the signal date. History tells us the odds of something like this or this happening in the next 12 to 18 months is extremely high, but what we don't know is where that starts from and how far we fall. Which is why in last week's video, after an ugly, ugly week in the S&P 500, we said, look, we still have potential support close by. We showed similar areas of potential support on the DeMark chart last week as well. History also tells us that when we're down here and down here a week ago, or even walking forward next week, we still need to respect multiple paths over the next 12 to 18 months. This is the rate of change study that we covered in last week's video, and it provided a similar message. Highly uncertain and variable over the next 12 months, and then really good things happened in the historical cases. If we look at this case and this case specifically, what happened from the date of the signal? The average gain in the S&P 500 was 6%, and that occurred over 117 calendar days. So in both cases, there was some gain before the pain, but the pain, on average, was pretty painful. After the 6% rise, the average drop was 14.49%. If we follow the average path in 2021, hypothetically, the market might peak somewhere around May 18th, 2021, somewhere in the neighborhood of 4,100. And then unfortunately, historically, it could drop all the way back down to 3,500, a level we talked about in last week's video. And that low might occur somewhere in the neighborhood of October of this year. So history tells us we should be prepared for something like this and something like this, as well as a scenario where we have gains and then the Nordique logo undercuts the level of the signal date here. Thus, off of the low, when we were producing tables like this and they were all green, it was much, much easier to try to remain on autopilot. At this stage of the bull market, you really need to fly with your instruments because it's highly uncertain the shorter term path. And the drawdowns from a peak can be very, very significant. So thinking about multiple time frames, let's look first a little further down the road, then let's come back into the daily charts in front of us. It's helpful to know if history tells us we have some curves ahead, potential volatility, but then there's going to be a long bullish straightaway potentially. And we covered that thesis in detail in the December 18th, 2020 video, and we've talked about that dating all the way back to 2016. Interesting to note, we talked about the present day being somewhere in this area here, 1982, 1983. Earlier stages of a secular trend in the stock market. This week from the Wall Street Journal, February 2nd, 2021, something fundamentally that ties the present day to 1984, relatively early stages of a secular trend in the stock market. Disposable income rose in 2020 at the highest rate since 1984. And after that, really good things happened for a long period of time. Ton of charts to cover here. Since the concepts are similar, we will be moving quickly. You may remember from last week's video, we said it was possible that Monday morning we would blow right through all of this. So when that didn't happen on Monday morning, right off the bat, we learned something, and it was favorable. And then last week we said if we were able to get back up into this area here, a potential target, we would learn something else. What do we mean by that? At that point we asked, do the charts in front of us look bullish, or are we starting to see signs of risk aversion? Said another way, do we think we're somewhere in here, or do we think we're closer to something like this? NYSE advanced decline line here breaks a shorter term trend, a little bit concerning, rights itself and prints a new high for the rally. Not particularly concerning. Covered this chart, I believe, when the market was up in this area here, said this was potential support. Looks like we bounced at potential support, at least at the first pass, and then went on to print a higher high. S&P 500 during the session on Friday, February 5th, these were areas where we said historically it wouldn't be shocking if we pulled back to them in the next 6 to 12 months. Talked about that up here. Thus far, the pullback has remained within the historical norms. Talked about charts like this a lot in this area here, saying that they still had work to do. This chart looks significantly different from this point here where the S&P 500 tanked. Significantly different from this point here where the S&P 500 tanked. Same can be said here. This chart looks significantly different here where the S&P 500 tanked than what it looks like today. It's making a new low here. This is a new high here. Similar situation here, February 4th, diversified basket of bonds relative to more conservative treasuries, making a new high for the rally. Quite a bit different than what we saw in January of 2020. 2020. You can pause your video player here. This is a monthly chart showing the S&P 500 divided by the VIX in the middle. This is MACD here. It helps us with longer-term momentum. The S&P 500 is shown on the bottom for reference purposes. Black back over red, momentum turning back up, trying to turn back up. This here, similar to this, and this. After that, good things happen in the S&P 500. Does it always work? No, and that's true of any signal. There's no such thing as a flawless signal in the stock market. They all help with probabilities. The probability of good things happening relative to the probability of bad things happening, meaning the probability of bad things happening was not zero here. It's never zero. Could spend a lot of time on this chart. Net of it is VIX tried to break out into this area here, couldn't hold it, and now it's possible it's going to make a lower low. Daily VIX tried to recapture the 200-day in red, not holding it, 3 consecutive daily closes below. Look at momentum on this chart here in Q1 when really bad things happen in the stock market. Williams %R holds above the center line. This is somewhat of a failed momentum breakout. This is bearish for the VIX. How does that get reversed? You get up here and you hold the overbought territory in the short run. This is a pretty rare move in the VIX here. This is a big drop in a short period of time. LPL Research, Ryan Dietrich handle right here. Typically, good things happen after a 4-day drop in the VIX. This is S&P 500 performance 1 month, 3 months, 6 months, and 12 months from the date of the signal. A lot of green here telling us it's possible this is what our Nordique phase will look like. We covered this chart in detail last week. Moral of the story this week, nothing particularly new, but it's moving in this direction. That's typically favorable for the stock market in the short run. That may change up here. Growth stocks relative to treasuries. Couldn't really print a new high here. Bad things happened in the stock market. Today looks significantly different. And there's no market law that says a rising wedge pattern has to be bearish. In fact, a breakout from a rising wedge can be incredibly bullish, and that's exactly what we got in late November, early December. Similar themes here. Home builders relative to treasuries. Somewhat of a failed breakout look here, 2018. Now we're recapturing it. This look here, almost a polar opposite to Q1 2020. Really, everything that we just said about the last chart applies to this chart. High yield bonds versus defensive treasuries. Here's your COVID gap down here. We've been consolidating in that gap. Broke above it this week. The longer this breakout holds, the more relevant it becomes. Ratio made a new high for the rally on Thursday, February 4th. It's quite a bit different than what we had here and here. This is a bearish divergence relative to the S&P 500. We've been talking about this stall in recent weeks. Looks like we're trying to break out. The longer it holds, the more relevant it becomes. Still can go either way, but right now, it's still leaning in a favorable manner. This is JNK relative to IEF. We can still learn something looking at JNK versus TLT. Resistance, pre-COVID. This looks quite a bit different. 61.8% retracement. Could act as potential resistance in here. Remember when things were really ugly in October? Talked about these charts a lot and said they really don't look that bad. And we talked about the longer a market goes sideways, the bigger the move that you can expect to get if you get a bullish breakout. Fast forward to the present day thus far, that's exactly what we have. This looks a lot more like this relative to what we've seen in the rearview mirror. This is a pretty steep slope here, so some givebacks along the way, even if good things happen, would not be shocking. Steep slope consolidation. This is another breakout look, equal weight S&P 500 RSP relative to IEF intermediate term treasuries. Breakout, pullback, and then push to a higher high on a closing basis on Thursday, February 4th. On all of these charts, we'll learn something either way. Stay above the blue line, it leans bullish. Get back down here, bearish probabilities will start to increase. Like many of the charts we've looked at, fair to say this looks different relative to this, and this. Low volatility stocks relative to the standard weight S&P 500. This is what increasing fear looks like as the stock market's plunging. This is what increasing fear looks like before the stock market plunged, making higher highs. February 4th made a new low since the rally off the March low. Hard to make an argument that this looks like increasing fear at the moment. Similar situation here. We've covered this in the past. Compare the look of the moving averages and price here as fear is increasing here before the stock market plunges. This really doesn't look anything like what we have today. Blue, the fastest moving averages on top. Price is above all the moving averages, and the moving averages for the most part all have positive slopes. Blue, the fastest moving averages on the bottom. The slopes are all down. Price is below all of them. Is it possible that this chart morphs into something like this? We all know the answer. It's absolutely positively yes. And we also know it could happen, but it hasn't happened yet. Markets are fractals. If this type of look is relevant on this time frame, it's also relevant on much longer time frames. This is TLT bonds divided by SPY. So this is what increasing fear looks like as the stock market's peaking in October of 2007. You can see we're moving sideways and then we tank. Breakout, get above the 50-month moving average. Present day, failed breakout, bearish breakdown below the line, and we're below a downward sloping 50-month moving average. This really doesn't look anything like increasing fear here. Remember, we covered this stock versus bond chart in the January 22nd video. And we said, based on the rear view mirror here, especially here off of the low, there's a bias towards a balanced portfolio. 50% stocks, 50% bonds, let's say, because it's worked well in the rear view mirror. Recency bias tells us when we're up here, we know what's going to happen. We're going to fall to the bottom of the box. When we're up here, we know what's going to happen. We're going to fall to the bottom of the box. All of that speaks to human nature. And this speaks to actions actually taken by individuals since 2008. Investor flows. 94% of the money went into bonds. Only 6% went into stocks. How does that chart look today? Still looks the same relative to what we described on January 22nd. Next 12 to 14 to 18 to 24 months, history says a little bit uncertain relative to what path we could take. Trading the chart in front of us can help with this uncertainty in here. However, all of the studies that we're doing, all of them are still saying if we can keep our eyes focused a little bit further down the track when all of this is going on, the rewards 3, 4, 5, 6 years down the road could be outstanding. Walking forward, nothing new, maximum flexibility 100% of the time, under all conditions. No bias about what tomorrow will look like. The studies that we've been doing in recent weeks, they tell us we should have contingency plans for all types of different scenarios. Stocks go higher, then they tank. Stocks go higher, then they consolidate. Stocks go higher, then drop below where we are today and consolidate, then go higher. It's much, much easier to deal with it in real time if you've thought it through in advance. This week, we were looking for signs of fear and risk aversion. Monday through Thursday and into Friday's trading session in the morning, we don't have that evidence at this point. It can change at any time. Are we allocated properly based on the chart in front of us and the data that we have in hand? Wake up tomorrow and do the same thing all over again. The studies tell us we have to respect how markets operate in the real world, even in the context of a longer-term bullish trend. This is what the real world may look like over the next 12 months. But until we see something different, this is the base case from a longer-term perspective. Shorter term, a little bit more uncertain. And we know to properly execute, we have to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.